there's so much out there in terms of political battles and the new world order things and stuff. So I think that all goes into the pot for gold, and obviously debt's through the roof. Post bust, my gold target, and this is probably early 2030s, is 20,000. And that looked great when gold was, 2,000 or 3,000. Now that it's run up here and may run up to 7,000 or close to 7,000 this cycle, 20 doesn't seem like a long shot anymore. It looks pretty reasonable. I think the likelihood is that 20 is going to have to be bumped up, that may be way short of where it ultimately goes. Silver, I have a target of 500. I am almost sure that that's going to prove too low.
The current financial landscape is increasingly defined by shifting geopolitical alliances and the looming threat of a global New World Order, factors that are acting as high-octane fuel for the precious metals market. While gold has already made significant strides toward the $7,000 mark in the current cycle, this move is likely just the precursor to a much larger post-bust revaluation. As the global economy moves through an anticipated deflationary collapse followed by massive central bank intervention, a gold price of $20,000 by the early 2030s no longer appears to be a contrarian long shot, but a mathematical necessity of currency debasement. DavidHunter, chief macro strategist at Contrarian Macro Advisors, argues that the current melt-up is the final parabolic phase of a 43-year secular bull market. He maintains that while gold is on a path to five-digit territory, silver is poised to deliver even more explosive gains, with a long-term target of $500 per ounce. As the great bust of 2026 unfolds, wiping out traditional equity valuations, the subsequent reflationary cycle will be driven by a commodity supercycle, unlike any seen in modern history. For investors, the takeaway is clear. The current targets of $20,000 gold and $500 silver may actually prove to be conservative once the full scale of the coming monetary reset is realized. Positioning in physical metals now is the only way to safeguard wealth before the credit system reaches its ultimate breaking point. Now, we present the clips from DavidHunter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Last October, I raised my silver target to 125, and it had been, I had been 75 for a long time. I raised it to 100. I can't remember exactly when. And then last October, I raised it to 125. Gold, I raised from 4,000 to 5,000, and then in October raised it to 5,500, and was obviously very bullish. This last sell-off that you just mentioned, I raised my gold target 6,800 after the sell-off. I mean, I didn't do it ahead of the sell-off. I actually called the sell-off. I was on a podcast the day before it started rolling over and said you could see a 30% sell-off in silver and maybe 10 to 15 in gold. And then when we got it, I said, that's cleared the air for another big advance. As much as it was parabolic in silver, I didn't react to it the way so many did, as this is the top. And I raised my silver target to 180. And I think you could see that by summer. I raised my gold target 6,800, as I said. So I'm extremely bullish. I think you are seeing, it corrected a little bit here recently, and the miners too. And I think, well, obviously we're still dealing with the sell-off. So it kind of went down, came back up some, went down some, went back down some. And now I think we're ready to go. So I think you're going to see that run to 180 in silver very quickly here in the next, 3 to 6 months, and gold to 6,800. I was always pretty much the high on the street in these things. More recently, I think there's a couple people, Michael Oliver, I guess, and I think his first name is talking, 300, 400, 500 silver. And I have that out there late this decade, early next. I don't think you get it this cycle. But I do think after what we've just witnessed and what I think we're about to witness, that 500 for me is probably a very low estimate for, the late 20s and early 2030s. I'll probably have to raise that, but I just don't, I could be wrong, but that'd be quite a run to see that happen this year. There's no question that, and we have that whole narrative about the BRICS going to a gold-backed currency so they can kind of subvert the dollar. And so I think that it all is kind of the same big picture of, those that are on the other side of the U.S. wanting to see the dollar dominance stop. It's funny because we years ago decided rather than military action, we can do things with sanctions, and with our strength as a reserve currency, we can do a lot. And obviously, when you bully people financially, they start trying to figure out ways to get around that, and ways to prevent you from doing that. So I think that's really a lot of what you're seeing, certainly from China and Russia and the BRICS, et cetera. I think there's more than that, obviously, for gold. Gold is, some of it is kind of catch up on all that money printing that we talked about over the last decade. Some of it is there's a lot of stuff going on out there geopolitically, not just Ukraine. It's Iran's obviously there. There's a lot of instability in the world, even though, I think Trump is doing a lot to try to calm things down. It may not seem like it while you're in the midst of it, but I think we're moving more that direction than the other. But still, while you're doing it, it does feel like there's a lot of turmoil out there that you got to guard against. There's so much out there in terms of the political battles and the new world order things and stuff. So I think that all goes into the pot for gold, and obviously debt's through the roof. And there's a lot of people saying, I want gold. If we're going to just continue to expand money and continue to expand debt, I've got to have something that's, gives me grounding in terms of what can offset that. So I think that's all there. I am not in the camp that thinks we're imminently close to a reset or imminently close to the dollar losing its reserve status. We're still in the, I think, mid 80s or high 80s in terms of the, trade that's done with the dollar. So as much as they're making inroads and it's come down a little bit, it's not. I am, however, a bear on the dollar, and I've had an 82 target out there for a long time, and I think we could see that this year. So I am in, it's DXY, so I am in the camp that thinks the dollar is going to come down a lot here, and that will certainly boost that narrative that, gold's the only game in town. You need to have a hard currency. But I think on the other side of that, when we get the bust, the dollar could go from 82 to 120, and we're right back in the other side of that story. So I'm not in the camp that says reset or, gold-backed currency is going to be the thing going forward. That may happen, but it's probably still many years off. We won't get into it here. I don't think we have time, but I have a view that out of the bust, because of all the money printing, you'll have a very inflationary recovery cycle. Very inflationary, where the U.S. could see 25% inflation. And then with the debt we have in the system, and again, not just here around the world, it will lead to, I think, a collapse of the system we've lived under for, certainly the last 100 years, 100 years. So we could see something worse than the Great Depression, drawn out, and truly a collapse of the financial system around the world. In there, anything could come out of that. Hopefully it'd be something like a gold-backed currency and more, starting fresh and more stability. And because we've spent, I call this, we're in the last decade of super cycle, what I define as the long cycle between two depressions, the 1930s and what I think will be the mid 2030s. So it's basically a 100-year cycle. And it's also what I think from post Great Depression, every cycle we've ratcheted up more. It's taken more. We've cranked it up. You've gotten inflation, and initially it didn't take that much to crank it down. Each successive cycle, it's gotten more extreme. So now we're at the point where, the ups are more extreme, and what it takes to bring the inflation down or bring the system back down into order, they overshoot, and it's a bigger event like the bust would be. So I think we're at that point where we're in the last decade of that super cycle. We're also at the end of what I call an 80, 90-year Ponzi scheme, because of all the each successive cycle, the debt just went higher and higher and higher. And now it's accelerating at a much steeper rate.
The precious metals market has entered a final parabolic stage of a century-long supercycle. Despite the recent volatility that cleared the air, the structural path for gold and silver remains aggressively higher as global debt acceleration enters a terminal phase. Current technical projections suggest gold is on a trajectory towards $6,800 within the next 3 to 6 months, while silver is positioned for a rapid run to $180. This move represents the culmination of a coiled spring effect, a delayed market response to decades of monetary debasement and the weaponization of the US dollar through financial sanctions. We are currently navigating the final decade of an 80 to 90-year monetary Ponzi scheme that began post-Great Depression. Each successive economic cycle has required more extreme debt expansion to maintain stability, leading to the current environment where the US dollar, DXY, is expected to drop toward the 82 level before a potential systemic bust. While the BRICS nations seek to subvert dollar dominance through gold-backed alternatives, the true reset may not occur until a mid-2030s. Depression forces a total collapse of the current credit-based system. Until then, gold and silver remain the only grounding assets capable of offsetting the inevitable 25% inflation rates and the terminal decline of fiat purchasing power. Let's get back to the interview.
I get a lot on X, people complaining about the silver miners or the gold miners. And I remind them that many of them, if you look at them, have tripled off their bottoms, or some even more than that. So it's a little hard to be disappointed with them, but I get it. On the basis of where silver and gold have gone, they're still in catch-up mode. And I do think we're going to see that in the next 3 to 6 months. Again, at the same time I raised silver and gold, I raised my targets on my, I target GDX, GDXJ, SIL, and SILJ as proxies for the miners. My GDX number, I've raised that to the GDX. I raised to 180 from 150. I'd raised it from, I think, 100 to 150 back in October, and then this most recent increase, I increased it to 180. My GDXJ was 210 last October. I've raised that to 250, and that was up from, it was $100 target, less than a year ago. SIL, I have at 220 now. It had been 180, and that had been raised from 150. And SILJ is now 90, up from 75. So, and that had been raised from, for the longest time, for many years, I had a 35 target when silver was down at single digits, or SILJ was down at single digits. And people were questioning, and I was even questioning, are you going to get to 35? And now, my target's 90. So, and again, these are not targets for 2 years from now. This is this year and probably this summer. So I think we're in for that catch-up rally that everybody's kind of been waiting on. And just based on what I see today, I think we may be just beginning. Copper looks great here. I have an $8 target for copper, and I think it's now, it's under 570 or something like that. So, it got up to 6, backed off all the way back to 3 something, I think, and is running again. I think you can see $8 this year. That's my pre-bust target. I think in the bust, again, a bust is going to be a really tough global economy. You could see copper fall all the way to, $2 or $3, maybe even below that. And then post-bust, I wouldn't be surprised to see copper at $20 or higher. Because again, with all that money printing, with all the reshoring we're going to do, with, all the, expansion and due to AI, et cetera, commodities are going to be in demand everywhere. It's going to be so-called commodity supercycle, something bigger than we've ever seen in commodities. Prices will go through the roof in most commodities, including ag. That doesn't necessarily fit that part of the story, but I think you're going to see all that money is just going to flow through to inflation and demand for commodities ultimately. So by the early 2030s, copper could be north of 20, oil could be $500, natural gas, pick a number, but I think you could see natural gas down to $1 in the bust and then be $50 or more in the early 2030s. So I think we're going to see something I lived through. I was a portfolio manager back in the early 1980s. This will surpass that, but it will be very similar in terms of commodities will be the story, and we are getting obviously a mini version of that now. I mean, commodities are coming alive here. Materials are waking up, starting to move up. So we're getting, but this is not. It's not a straight line from here to there. You've got that bust in between that'll take prices back down. And then from a much bigger hole, it'll be an amazing run. So certainly the base metals, you'll see it in all the metals. I think you'll see it in steel. You'll see it in pretty much all commodities that are going to be out there. So the tech commodity is obviously semiconductors. I just I don't know how to read that one, because tech is not going to be what it is this cycle. Next cycle, it will, there'll be pockets of tech that'll do well, but tech's going to be like it was in the following the .com boom, is going to go through, and from a stock standpoint, going to go through a period of distribution where every time it lifts it ahead, there's another group of sellers because they were overowned. They were the winners of this cycle. Every time you go to a new cycle, there's new leadership. So semis may be the exception to that. There may be just so much demand that they have the pricing flexibility, because that's the key of the next cycle. That because of inflation going to 25% and interest rates going to the high teens or 20, it's going to mean that you've got to be in stocks who can produce earnings that have pricing power, can produce earnings that exceed inflation and also exceed interest rates, because your PE multiples are going to be shrinking as rates go up. The market multiple goes down, PE multiples go down. So unless you can produce earnings at a much more rapid pace, you're not going to be able to keep pace with inflation. So those that are since the mid 80s, it's been a great strategy to own an index fund and just leave it there. If you listen to the mantra from Wall Street, from the financial folks, financial advisors, it's timing the market, not timing the market. From the mid 80s till now, that's been the mantra, and it's been absolutely correct. Going forward from middle of this year, I think it's timing the market, not timing the market, because like you said before, I do believe we could see an 80% decline in the market. That means there'll be some that'll exceed that, and some that'll be under that. But on average, the indexes could fall 80%.
This pre-bust momentum extends beyond precious metals into the broader commodity space, with copper targeting $8 this year before an eventual global economic slowdown. While a significant bust could temporarily drive copper back to the $2 to $3 range, the subsequent post-bust recovery is expected to trigger a commodity supercycle of unprecedented scale. Driven by massive reflationary efforts, reshoring, and the infrastructure demands of AI, we could see $20 copper, $500 oil, and $50 natural gas by the early 2030s. For the first time since the early 1980s, the buy-and-hold index strategy is being replaced by a critical need for market timing, as a potential 80% decline in traditional indexes looms before the ultimate commodity-driven recovery.